All right, good afternoon, everybody. Chris Lester here. Today's topic is going to be tornado watch versus tornado warning. This is the last part of a four-part series that I put together to help explain some terminology, thought processes, and strategies on a go-forward basis. If you're new to this call, have not been on this call before, I'm a financial advisor, been in the business 30 years. Most of you probably know me. I also work with a bunch of advisors in the field across the country, and we're like-minded in our approach. And we believe in holistic approach to financial planning, which is offer education and sound advice, and then strategies can be implemented. If you've been invited here by another advisor and you have questions after this call, I'm going to ask you to circle back to that advisor and they can guide you. If they're not able to answer the question, then certainly feel free to reach out to us. So without further ado, Core Investment Theories has been four parts. In the beginning of April, we talked about stocks and bonds, and I don't like to make any assumptions that we understand some of the vehicles that we invest in. So I did a little bit of a, pretty basic, but hopefully insightful education on stocks and bonds and why we diversify. And that led us into unsystematic and systematic risk, right? And understanding that certain risks cannot be diversified away regardless of what happens. And that's systematic risk. And then the milk cow and the hunt for yield. I've been talking about this for years and I will continue to talk about it. And this is a second part of a strategy because we had been discussing structured notes as a yield option, or maybe portfolio designs that create yield. And as folks approach retirement, just because something worked in pre-retirement years, or what we call the accumulation phase, does not mean that that's the best strategy once we hit retirement. So we have to understand, how that may or may not affect our portfolios and the risks that we might be taking unknowingly or unnecessarily. And today we're going to talk about tornado watch versus tornado warning. I know I said that backwards, but obviously you would have a watch first. And, I started to allude to this last week. I live here in New Jersey and a lot of my clients in New Jersey, and they're familiar with flood insurance. But because this is a national call and a lot of folks are from across the country, I felt, tornadoes, we all grew up with Wizard of Oz and we're not in Kansas anymore, but the Midwest is prone to tornadoes and they're more familiar. So the first part is to understand that, what I'm going to suggest here is just a strategy. It is not an overall portfolio solution. It would be considered what we call a satellite, right, to an underlying portfolio structure. So we've talked again about structured notes, or maybe some of the ARC investment strategies, and this could be something in addition to if we wanted it on as an outlier. So keep that in mind. Tornado watch versus tornado warning. I went to high school in Somerville, and I remember sitting in high school, every day at 12 o'clock, you would hear the alarm. You knew what time it was. That's how they told you it was 12 o'clock. And we knew lunch was near and we're heading out to the playground. But if alarms sound in the Midwest, it's time to seek shelter, right? That there's something coming on the horizon, right? But it doesn't necessarily mean that the tornado has touched down. But, although rare in New Jersey, there are occurrences where that could in fact happen and has happened, right? But we all know, and nobody needs to be reminded, that tornadoes are absolutely devastation in what happens in their path. So, these two gentlemen I was introduced to, for those of you that have worked with me know that Brookstone purchased Formula Folios and opened up a whole new suite of options of investment philosophies. And over the last couple of months, I've had Mark Diorio, who's the CFA and the Chief Investment Officer, talk about structured notes as a yield alternative. And Brookstone has been paramount in helping us build out income portfolios for our clients that are approaching retirement. So with that said, part of their association, they had these two gentlemen. Michael is the older brother, and I was hoping to have them on today, and Matthew's the younger brother, but they could not make it. So I've had a chance to speak with them at length. These are two very sharp young men They've been in, following the investment world for about 20 years. They're both CFAs, certified financial analysts. And, basically, when it comes to investments, they're some of the smartest guys in the room. Their storyline is when they were first introduced to investments was in the internet bubble burst in the early 2000s, and what they were presented with was traditional planning, which is almost a forecasting philosophy, prognostic, right? That you're sort of looking to predict based on certain holding of stocks and earnings and gross domestic products, so the incomes, all the things that go into evaluating whether a stock is a good holding, building a basket of stocks. And then they experienced it just like we all did, an internet bubble burst. And so that again is systemic risk. And then in 2008, as they went to work for some private banks, they ran into it again, right? Some of that education led them to start to look for alternatives to this risk that people just can't afford as they approach retirement. So they are a specialist asset management firm born from advisors, but then they were looking at risk responsive investing. They're using proprietary volatility dashboard. They created this sort of forecasting, or better word would be analytics, of the data that is now accessible. So for those of you that don't know, volatility is measured on an index called the VIX. You'll hear me refer to that, VIX. And that's been around quite a while, right? I think it was, if I was to recall, in the 80s is when the VIX first created, but it really became sort of mainstream in like around 2004. People started to look at it. It is now the number one measurement tool for leverage and hedging, and everybody in the world uses the VIX as sort of a arena, a volatility index offered on the Chicago's Board of Options and Exchange, CBOE. And what they did and what they were starting to able to find out as they were building out this dashboard is that there's data that can be gleaned from, for lack of a better term, momentum, or from overbought, right? So when they see the big institutions stepping in to purchase VIX, right, that is a telltale sign that there is concern in the marketplace. So think of the VIX as a fear indicator, right? It's just a sort of a measurement tool to determine, is there fear in a specific industry or index. So it's a leading indicator. It's not perfect. It's not always right, but it is a tool that they have now combined with other data, look at and say, hey, there is a tornado warning. The winds are moving in a direction that suggests that we could have a tornado. And the example that I gave last week that I think for me is close and personal, because I lived through Hurricane Sandy. I know that the federal government and a lot of banks and mortgage companies require flood insurance if you own a home near the shore, right? Up and down the eastern seaboard. And I also know that our area here, I live, 50 miles inland, that there was talk of them requiring flood insurance this far in. And you think about it, when you go to buy a home and you want your second home or maybe your primary residence near the shore, the last thing you want to do is buy a house and have a hurricane or something wipe it out. Well, the same thing could be said for if you're in the Midwest and you don't have the ocean, right? The last thing you want is for a hurricane to come through and wipe it out, and for whatever reason not be covered. So, insurance is the logical solution. The problem is it's expensive to have on all the time, right? It just is, if you add that to your overall cost, it's monumental. So what these folks have figured out how to do is how to put the insurance on when it looks like something is likely to happen. And this is just a risk management philosophy. It just shows a hypothetical growth from 2000 to 2020, and the difference of if somebody were just put $1,000 in the S&P buy and hold and go, just set it and forget it. That's the black line at the bottom. And after 20 years, okay, it tends to trend up. And we know this, right? But human emotion tends to take us either out of the game. And for the people that do this, what if we could say, hey, you know what? I don't need to get 100% of the upside. I'll take 80%. But if we could prevent 50% of the downside, is that possible? And that's what their volatility tool indicates. So, they're listening to messages from the VIX. It's a volatility dashboard, and the red lines are where they're stepping in and saying, "Hey, we're getting the alarm has gone off, and it looks like we should signal on, right? So we're going to step in and buy insurance right now on the portfolio." And they're not buying put options like you would normally think, right? They're actually buying another index, right? It's called the volatility ETF that they're stepping in that basically insures the portfolio. So the analogy that I would give, suppose we had a magic wand that basically says, if you buy insurance, we're going to put a cinder block building around your house. So if you're in the Midwest, tornadoes come in, we're putting this cinder block completely protected. And as soon as the tornado passes, they take it off. That's what's going on in its most simplistic terms. So this is, like I said, it's signaling is either on or off. If it's off, they're typically getting to 100 to 120% of the S&P, right? This is their smart index approach. Now, what's cool about these guys is that once I met them and we had a chat with them, we said, hey, we would like you to build out this same philosophy on a income portfolio. So remember, I've been talking about yield of late, and that is another way, right? So indexes, so I talked to them recently, and they basically said they have now finalized that is now available on the Brookstone platform, where we could have 3 indices, right, that are yield generating, and they're getting averaging 9.5% right now with this strategy. So you take out the fees, which typically for our advisors is 1.5%. You're now around to 8. I try and talk to clients saying, listen, if we can get 6% net of fees, that's the goal. But when the signal's on, we're only going to get 80 to 95% of the S&P exposures via the ETFs. And one of the signals that they're looking for is typically if they're having a 4% intra-month S&P decline, that's when they're saying, hey, Houston, we have a problem. Let's step in and buy the insurance. They're not always going to be right. There is some expenses along the way, but overall, long term, it makes a lot of sense. So this is just, again, with their smart index, it just shows, to the left, if they just had a standard, 60% S&P ETF, the SPY versus an aggregate bond index, the AGG, that, if you look on the left side is typically how this portfolio would have performed from 2016 to 2020, right? Versus their strategy using this investment strategy. So you can see that, it has potential to earn a little bit more. The volatility is reduced. The drawdown is reduced by 12 to 5, so almost cut in half. It's upside capture, like I said, about 75%. They're not going to get all the upside, but when it drops, they're not going to have all the loss. Now, if I turn around and put some returns to this data, right, in 2021 year to date, it's 6.5%. But last year, even with COVID, this strategy, and this is where they actually started, because when you're participating in a strategy that was a systemic event, such as COVID, there was actually opportunity to make some money. But you can see that since the inception of this strategy for the last 5 years, that it's done pretty decent, right? So you don't see a lot of, even in 2019, you had 1 month of -7, but overall the portfolio finished up 24. Now, does that mean it's going to be like that every year? No, right? We have to manage expectations, but having a strategy or a portion of our portfolio in place is, I think, wise. Now, here's the issue that I always will often talk about. When you have your funds at your 401k, at your TSP, at typically your employer, you don't have access to these strategies. So, having and thinking about utilizing strategies like this, working with an investment advisor that understands what your goals are, is, I think, prudent. So if this is something that is appealing to you, you want to learn more, put it into your portfolio, find out how it works, contact the person that invited you to this call, reach out and make an inquiry. Now, these are some of the notes and glossary, notes on leverage and inverse ETFs, standard deviation, Sharpe ratio. If you want to learn some more, I've actually done some videos on some of these, so you can go back into the library on LinkedIn and look up some of that stuff. But at the end of the day, that's why I try and keep the topics pretty light and easy to understand so that you can say, hey, look, technology is here. These guys are using it, and I like it as part of our solutions. Disclosures show that I didn't make up this language, and this is my CYA. And then lastly, it's our contact information. We invite you each and every week to join us here to learn a little bit more about what we're doing. Next week, I think, I've been thinking about it because they postponed the tax day to May. I'm going to talk about Roths conversions, the impact of rising taxes. I don't know if I'll be able to cover it all in 1 week, but that's what I'm going to work on for next week. So if you've been intending to, start to convert Roths, want to figure out how to do it, maybe you're under the misunderstanding that you can't contribute to a Roth because you make too much of money. There are strategies that you may be able to implement either at your employer or individually to start to take advantage of tax-free income into the future. I think it really is something that everybody that's on this call needs to be thinking about long-term, because this country has a spending problem. And at some point in time, the bill to collector is going to come due. And if we have all of our money in IRAs, 401ks, TSPs, it could be a painful experience. So I'll show you more about that next time. Folks, I want to thank all of you for being on the call. Thank you for taking time out of your week and joining us. And if you have any questions, please reach out and look forward to helping you. Have a great day. Bye-bye.